Hi, it's Arjun. We had intended this week to publish a written note that looked back at the last 4 years of what we were going to call a mini cycle for the energy sector, where 2024 energy commodity prices and profitability was very similar to 21. We had the big boost in 2022, and we've done a bunch of work on the subsectors and the volatility of the returns, the actual returns, and it made some points that I thought were interesting. And hopefully we'll get to publish it in either next week or the week after. But clearly, after such major market moving news, we don't like to react to the news of the day or provide quote hot takes on super spiked. It's not what we're about. But when you have had such a dramatic move after obviously President Trump's Rose Garden event and whatever trade war we're now embarking on, and then you add in OPEC not wanting to be outdone and deciding to add some additional news about additional oil volumes coming onto the market. And we've seen oil equities, oil commodities, and the broader market just get totally crushed today. I think there is a need to just adjust our plans and at least provide what we're going to call our long takes. We're going to try and stick to our long-term perspective on putting this news into context. And we're going to say all that with the caveat that we're one day into this. I'm recording this Thursday, April 3rd after the close. We do not know what news is going to come going forward, but we just wanted to provide some initial thoughts at least, and we'll obviously build upon this in future weeks. I think the first question really is, to what degree has this raised the risks of oil markets moving to trough, which we're going to describe as sub $60 oil, somewhere in the 50s for WTI. And then if we do move there, how long will it last? We have spent a lot of time talking about having a super vol mindset, which is specifically meant to us. You always have to be prepared to have 1.5 to 2 standard deviation moves in either direction, including to the downside, and that's why companies should retain fortress balance sheets and so forth. And I will say, and in the note we were going to publish, industry has by and large kept pretty healthy balance sheets. They've maintained capital discipline. So for however long of a down cycle we're going to have, the going into it conditions for most of industry is actually healthier than what we've seen going into past down cycles. Clearly, the odds of that downturn have grown. I think there was a growing sense prior to this week that, maybe we could kind of grind our way through this period. You're going to get a little bit of an OPEC increase and so forth. I think for sure the odds of having some greater downside and hits to oil demand and so forth have grown here. But when we think about duration of downside, I think the real question to us is not, do we have sub $60 oil? Anyone can have a debate or opinion on that. But that if we do, how long will it last? And we want to look back on kind of 4 major corrections over the course of my career, one of which was a little bit before the start of my career, is when a correction came at the end of a structural bull market. And by that, I mean 2014, the famous Thanksgiving event with OPEC, and the 1986 oil price crash. That was before my career. The subsequent downturns were multi-year in nature, and major adjustments to the business were needed. I'm going to contrast that with the great financial crisis of 08 and 09, as well as even the COVID deep trough. And while both of those corrections were painful, COVID especially so, both were actually non-energy events. They weren't coming at the end of major structural bull markets, and that it was a oversupply in effect and a weakening in demand that was causing the correction. Both were, it was housing and general financial market conditions in 08, 09. And while the downturns were significant and they were painful, and you wouldn't have wanted to been an energy investor during that time period, they're actually short-lived. And so again, we don't know how this trade war is going to play out. We do know that it is an event beyond the energy sector. This isn't really about energy supply demand. Yes, you can say, well, OPEC's raising volumes, but you know what? They have a little bit of spare capacity. If they're going to put it on the market, you know what? Do it now. Let's get this out of the way. Let's flush things out and let's get clean here. Our view is that whatever downturn we have is not going to be multi-year in nature. Now, we're not calling for or expecting some version of an extended depression. But again, the trade war is it's voluntary at this point. It is absolutely voluntary. It's actually different than COVID, which we're going to call involuntary. A global pandemic suddenly came upon the world. The great financial crisis, housing and all the issues there, it wasn't purposeful in that sense. This is something the US government has decided to pursue. We're not going to pass judgment in this video on what we think about it. What we are going to say is that it doesn't have to be. So I think it's very different than, again, the types of dramatic downturns from the end of super cycles that you had, say, in 2014 or in 1986. It's more like COVID and the great financial crisis, even though in this case, it is totally self-inflicted. I will say a couple other points on the sector. CapEx has generally been subdued. Despite much better profitability than the previous 5 or 6 years, by and large, companies have remained capital disciplined, and balance sheets for most of the sector are generally at much healthier levels than anything we've seen, frankly, for most of my career, but certainly in the last 5 or 6 years. So all that suggests a resiliency that we've not seen going into prior downturns, whether they were long-term or short-term in nature. I think the second point we want to make is, unless my Bloomberg is broken or not updating, the resiliency in natural gas, US natural gas, really does jump out. We've noted, we think this is a key future fuel. We see the optimism and understand the significant demand growth projections people have out there. I think the only point we'd make on natural gas is that for demand to grow, and when it has grown, natural gas has been price competitive. So we are optimistic about US and global natural gas demand growth, but we have not used the super cycle language for either US natural gas or LNG prices, for that matter, in terms of where we think the price cycle goes. I think it's actually critical for natural gas prices to remain competitive with all the alternative sources of power generation and industrial demand that you can have. And therefore, to us, it's about monetizing low cost of supply resource. And that can be a certain business model for US shale players, a different model for global major oil companies, but it really is about monetizing low cost resource. And it's not about super cycle per se in terms of the price. But I think the resiliency of natural gas certainly jumps out today. I think the final thing we want to address is, if you are a company, what do you do here? And I'm going to say again, I think the first thing you have to decide is, are you worried that this is the start of a multi-year downturn a la 2014 and 1986? Or do you see it more as the sort of, economic, global, macro kind of correction that we had in 08, 09, and 2020? That's the camp we're in. We've always supported, you have to do this in good times and bad times, running stress tests. And so even if you think it's like an 08, 09, or 2020 COVID event, the stress test to me means you actually have to assume an extra year of bad conditions, because that's what the market's going to assume. And so if you have 2 years of, let's just call it a normal trough, companies can decide for themselves what that may, maybe that's $50 or $55 oil, maybe it's something a little better, a little worse than that. There is a need to assume it for an extra year, because the market's going to do that. And the point then in run these stress tests is, what is your financial flexibility? What is your viability under probably a more draconian condition than what is actually going to materialize? And I think it can really help inform companies on how to think through financing and CapEx and all these kind of things. Long term, we know there is massive unmet energy needs of the other 7 billion people on Earth. That has not changed. We know that energy is always changing, and that there's always a need to figure out what is going to be the next low-cost resource. That challenge, that opportunity existed on April 1st and March 31st, and it exists today here on April 3rd. Nothing about that has changed. We know that, or we think, I'm going to say we think, this is an investor comment probably, or investor background comment, that the best M&A deals have typically happened during periods of weakness, concern, and people being freaked out about things. That was true at COVID. Look at the deals that happened at COVID. Those were some of the best transactions we've seen in a long time. And we can contrast that with peak of cycle deals. You also have to ask yourself, not only are we at peak or trough, but are we early or late in a super cycle? In 2013, 2012, we were late in the super cycle. In 2014 and 2015, things had corrected, but we were actually early in the downturn. By the time you got to 2020, you had your, I'm going to call it, ideal scenario of being late in a structural downturn and then also being in a short-term deep trough. And again, some of those deals really jump out. And our view right now is we're not early in a period of better profitability. But if you go back to the comments that CapEx has remained in check, and companies by and large have not gotten carried away with what were better conditions in 2022 and 2023, it also says we're nowhere, I don't think, we're nowhere near sort of the long-term structural peak of this cycle. So opportunities are going to rise. Unlike 2020 or some of the prior periods, most of industry is in better health. But I think companies have to be forward looking, and the time to lean in and take risk is usually when there is the greatest fear and uncertainty out there. Again, we're only in day one of this, so no one's saying anyone has to do anything tomorrow, but I think it's about preparing. How do you see this playing out, and what are the kind of strategic moves that you want to make? So some short initial takeaways. Those are the main points I want to talk about. I am going to stick to ending this on a personal note, and I think I have to make the theme market turmoil. And when I think about my 3-year career, the most memorable times were the scariest times, and they came with these major correction periods. I can still remember the Asian financial crisis in 1998. That was really my first real experience with sort of a major downturn and what do you do and deal with it. The second one was an awful event. It was 9/11, but also a very dramatic time for the world, for the United States, but also for oil markets. The great financial crisis, I mean, I can still remember individual days of being on Goldman's trading desk, of being in our office, of seeing dramatic moves in major, ExxonMobil having, 15, 20% moves on a daily basis, which totally out of character with a company of its size at the time. And a lot of that type of volatility that we saw back then and living through it really jumps out. And then, of course, we all remember the deep COVID trough. I mean, these are the times in my career where that they were the most interesting times. They came at times with tragedy and trauma, and that's unfortunate. But at least from just a pure markets perspective, this type of environment tends to be the most interesting. It's where I think you can make the most differentiated calls as an analyst. Where as a company, you can really make some moves that differentiate you from the pack. So our view is market volatility and the uncertainty is what it is. And once you get through it, you'll look back and I don't think you're ever going to forget it. So we'll stop there. Thank you.